In 1978, Deng Xiaoping declared that to get rich is glorious. And in the intervening 3 decades, China has seen probably one of the biggest creations of wealth in the history of the world in such a short period of time. But to many average investors like us, China's market is still pretty opaque and treacherous. So to help us wend our way through the issues involved with investing in China, I'd like to welcome Burton Malkiel back. He's been here a number of times, and he's the author of A Random Walk Down Wall Street. He's a distinguished professor at Princeton University. So could you join me in welcoming Burton Malkiel back to Google? Thanks.
Thank you very much, and thank you all for coming. Gee, I hate to have all of you guys standing, but I certainly appreciate the warm welcome. I am going to talk about China. I think, matter of fact, you've got a good title for me. I'm working on a new book, which will be on investing in China, tentatively with a title From Wall Street to the Great Wall. But if you guys have a good suggestion for me, I'm ready to hear it. Let me, just as background, before we get into China, give you some idea of what I think the sort of general investing environment is like in the United States, just as a contrast to the way I see things in China. My sense is we'll have something like 3% real growth in the economy this year. The first half is, the first quarter is going to be well above 3% when it comes out. In the second half, I think finally we're seeing the housing starts go down. We're seeing house prices starting to at least level off. So probably a bit weaker than that in the second half. But it's basically economy is still going to be growing. The way, and I think I've used this in previous presentations, the way I think you can actually estimate the long run rate of return from any kind of stock market is with something that's often called the Gordon model. Basically, what it is it's a present value model that says that the worth of any asset, whether it's a piece of real estate or whether it's a common stock, is the present value, that is the discounted present value, because a dollar next year is not worth as much as a dollar today, the discounted present value of the series of cash flows. And if you do that for the stock market, you come up with a number, the dividend yield of the market. That's basically what the Gordon model says. It's the dividend yield plus the growth rate is what gives you the expected return. And so for the U.S., I see things probably in something around the 7.5% area. And this is what you might expect for the next 10, 20 years. Now, the 10-year Treasury bond is about 5%. So what that means is that what economists like to call the equity risk premium, the amount by which common stocks give you a rate of return higher than bonds, is something like 2.5 percentage points. And that tends to be low because historically, from 1926 to the present, where we have pretty good data, stocks have given about 10.5 and bonds have been about 5.5. So it's been about a 5 percentage point equity risk premium. It looks like risk premiums tend to be low in the U.S. market. You can also see it in the bond market. There's an index of so-called high-yield bonds, bonds issued by companies with not the best credit. Sometimes these are pejoratively called junk bonds. If you look at the relationship between high yield bond yields and treasury yields, that gives you a promised rate of return of perhaps 3 percentage points. And that tends to be much lower than it's been in the past. And that's a promised rate of return of 3 percentage points higher than for treasuries. You probably won't get all of it, because if they are firms of fairly low credit, some of them are going to default. So you probably get net something less than that. But when you look at markets, that premium for risk in the bond market tends to be low. Another way to look at it is if you look at sovereign emerging market debt, that spread is also about 3 percentage points. And again, you know, they're going to be the Indonesias of the world where the rate of return, the promised yield doesn't in fact get paid. So when you kind of look at the investing environment, it looks to me like it's kind of a single-digit world, and it's a world where you don't seem to be paid an enormous amount for taking on risk. And that's the background against which I'd like you to think about the possibility of investing in China. Now, as Vijay said, I think you've seen in China probably one of the most remarkable growth stories that the world has ever seen. There is no country in its rapid development phase that has grown at something close to 10% a year. And this is since the reforms started by Deng Xiaoping in 1990. The Chinese economy has grown at something around 9.5% to 10% a year. And you know, you put it on a log chart, and the damn thing is a straight line. I mean, it's been so consistent. And everyone says, oh, it's got to slow down, and it undoubtedly will slow down. But the Chinese just announced that the first quarter was over 10%. I mean, it's just been a remarkable growth story. Now, I'm very conservative, and I'm saying, yeah, there'll be some kind of a slowdown, but I'm looking at least 7.5% growth over the next 5 years or 10 years. And the main drivers will be basically, you've had this enormous development on the coast, but the whole center of the country is yet to be developed. And you know, there are just hundreds of millions of underemployed Chinese who want to actually share this dream, this dream of to be rich is glorious, and it seems to me that I'm actually being very conservative, saying that the growth, the real growth after inflation is going to be 7.5%. Now, if I use the same Gordon model, that same present value model then for Chinese stocks, the dividend yield of the various indices in China is 1.6%, a little less than the US. The growth I put at 7.4%, again, pretty conservative. You'd get a 9% rate of return for investing in Chinese stocks. Chinese treasury bonds yield between 2 and 3%. So the equity risk premium in China looks to be a lot higher than the equity risk premium in the United States. And as my presentation will show you as we go on, for a US investor, I think you're going to get more than that, because a US investor is going to benefit from the appreciation of the Chinese yuan, which I believe is probably the most underpriced or undervalued currency in the world today. And I'll show you some data of why I think as you know, this has been a political football between the Chinese and the United States, and President Hu is now visiting here, and there will be some comments about how we can't let the currency change very much, and there'll be some comments on our side, gee, you ought to have it free float. And, you know, there'll be some compromise worked out, but as I'll indicate later, I think it's very likely, not a big appreciation, but you'll see something like 2 to 3% appreciation of the yuan over time. And what that would mean then for U.S. investors is something like an 11 to 12% rate of return for Chinese stocks, which then is one of the few places in the world where I think you're very likely to be able to get double-digit returns. This is the growth of the Chinese economy it's not on log paper, but as I say, you put it on log paper and it's a straight line. And let me now turn to the fact that I am not suggesting that this forecast is without risk. There are all kinds of things that could happen. And I've put on this slide the various risks that there are. I'm not going to talk about each one of them, but I've basically got the risks and at least a one-sentence answer to them. I mean, for example, people often say, gee, you've had this one-child policy, and as is happening all over the world, you've got an aging population. But if you calculate what the demographers calculate of a so-called dependency ratio, that is the number of people who are dependent relative to the number of people who are working, it actually looks worse in the United States than it does in China. We know that there are enormous tensions with Taiwan and Japan, but I'll tell you one thing about this government, and I've just been there for a couple of weeks and talked with a lot of government officials. This is a very practical government, and the fact of the matter is that Taiwan and Japan are so intertwined now with China, with trade, that my guess is that sure, you'll be reading about all of these tensions, but I suspect, look, there are all kinds of possibilities of accidents happening, but it's a very practical government, and my suggestion to you is that, in fact, these things are going to work out. But look, I'm not going to go through the whole list, but let me just say, yes, indeed, there are a lot of risks to the forecast. I think there are answers to them. But I would say, based on my recent trip, where I was able to talk with a lot of government officials and raise all of these issues, it's not that I think that the government has been perfect, and it's not that I think that these things are in any sense solved, but I came away with a very strong impression that things are moving in the right direction. That, you know, it isn't as fast as I would like. I think the Chinese are far too worried about the former Asian currency crisis than they should be, because I can't think of a currency that there's less likely to be a run against than the Chinese yuan. But, you know, having said that, it's not that everything's being done perfectly, but change is happening, and it is happening in the right direction. And the second reason why I'm optimistic and why I think they're going to overcome the problems is from something I remember so well when I was a young assistant professor at Princeton. One of the senior people was a man who won the Nobel Prize in economics, Sir Arthur Lewis, who was a development economist. And I remember at the time there was all kinds of disputes in economic development. Should should there be central planning or not? At one point, we thought central planning was the way that countries would develop faster. Should there be tariffs to protect industries or not? And I remember Arthur telling me, you know, I've been through all of these disputes in my career, and I've been through all the mathematical models of development. And after a lifetime of studying these issues, you know what I'm just absolutely convinced about? That if you want to know why one country grows and another country doesn't grow, look to the culture. Look to the work ethic of the people. Look to their interest in education. Look to their energy. And that's really what matters. You know, you can have a communist government and develop. You can do this almost any way, but what you really need is this cultural thing, is the kind of work ethic of the people. And I'll tell you, having been in China for 2 weeks, just really back a couple of weeks ago, you walk around a city like Beijing, you walk around a city like Shanghai, and you kind of can feel that entrepreneurship, that energy. I mean, it makes New York look like a sleepy town. And that's one of the reasons why I suspect that this miracle is going to continue, because you've got that culture, you've got that energy, and you've got it in spades. And that's one of the reasons why I'm very optimistic that this growth is going to continue. Okay, so let's say you buy my argument that, in fact, China is going to continue to grow. Government's they're not always going to make the right decisions, but you know, they're going to avoid disaster. There's a wonderful study that was done by some people at the London Business School that tried to correlate economic growth with how the stock market of the country did. And you know what they found? It's just remarkable, just not what you would have expected. There's zero correlation between the real growth of an economy and how its stock market does. And that's really very shocking in a way, that it's not so easy that you just look at economic growth and you know, some of the people may get wealthy, but that doesn't mean that the investors can. And it certainly has worked for China, because there are two stock markets in China. One is a stock market in Shanghai, and the other is in Shenzhen, which is just outside of Hong Kong. And if you look at the rate of return of the stock market in Shanghai, the 1 year to the end of last year went down 8%. The 3 years went down 15%. The 5 years, it went down. It has been a terrible place to invest. The stock markets in China have had negative rates of return. Now, having said that, however, there are two other ways to do it, and I'm going to talk about these later. There is an index called the FTSE, that's the Financial Times, the nickname is the FTSE, and it's called the FTSE Xinhua Index, of 25 Chinese companies. These are mainland companies whose shares are traded in Hong Kong. And those stocks actually have done well over the last year, the last 3 years, the last 5 years. And there is another index of Chinese companies that list their shares in New York, register with the Securities and Exchange Commission. And there is a U.S. traded ADR index called ADR is American Depository Receipt. There's an ADR index, and that's also done extremely well. one of the problems in China, there's kind of an alphabet soup of shares. These are basically three different types of shares. The A shares are for local investors. The H shares are traded in, H for Hong Kong, are traded in Hong Kong. They're available to international investors, but not for local investors. And then the N shares, which are the ones, N for New York, that they're traded New York, many of them on the New York Stock Exchange. Well, this certainly shows you, though, that the local market hasn't done well despite the growth. And yet these other two markets have done well. And that then leads to the question, why has there been this divergence in terms of how the different markets have done? What explains why the local shares have done badly? Well, let me give you the sort of theory of Chinese institutional investors, many of whom I've been talking to. Yeah, don't shoot the messenger. It's kind of a sexist way of putting it. But let me just, I'm just quoting, and I apologize for this. But the Chinese institutional investors have something that they call the pretty girl theory. And basically what they say is the government decides to allow the prettiest girls, the prettiest companies to list in New York. They allow the pretty girls to list in Hong Kong, and the local investors are stuck with the most unattractive ones. So that's the pretty girl theory, and let's see if we've got any evidence that pretty girl theory actually works. Well, if you actually look at the earnings growth of companies that are A-share companies, the earnings growth of the H shares, that's the FTSE index, the Hong Kong index, and the earnings growth of the N shares, the American Depository Receipt shares, you'll notice that over, let's just look at the line 2000 to 2004. You've had 9.5% growth, pretty much like the economy grew, for the A shares, but much higher growth for the H shares and even higher growth for the N shares. Take another statistic. I could give you a whole bunch of statistics on this. Take another one, return on equity. Return on, this is the earnings versus the book value of the equity. Return on equity. Again, average a little under 8% for the A shares and double-digit returns somewhere around 15% for the H shares and the N shares. So there is some evidence that the better companies do list in Hong Kong and New York. And the government, basically, what's happening here is the government is telling the companies where they can list, and the government wants to advertise what a great place China is, and it is basically making a selection of not anybody can list in New York or Hong Kong. The government has to approve it, and essentially what's happening is that the better companies seem to be listed in Hong Kong and New York, and that's one of the reasons for the differential in performance. But you still may come back to me and say, but wait a minute, Bert, that doesn't seem to be completely satisfying, because after all, even these lousy, unattractive companies in Hong Kong still had their earnings grow at 9.5%, about along with the economy. Why still? Why didn't the local shares do better? And I think the answer is that basically valuation relationships changed. When the Chinese stock market opened up in the early 90s, everybody thought, boy, this is the way to get rich. And Chinese A shares were bid up to price earnings multiples over 100. the price earnings multiples, much worse than Google's price earnings multiple. The price earnings multiples were in triple digits for a long period of time. And essentially what's happened is that those price earnings multiples have come down as the market has matured. And in fact, the number for the first quarter, which I just got, is 14.7. In other words, the A shares now sell at a price earnings multiple that is at world standards. And the reason that 9.5% growth wasn't reflected in positive security returns is that the price earnings multiples, and I've got just from 01 there, but if I went back to the 90s, you'd have them in triple digits, is because the price earnings multiple collapsed, and even though the earnings went up, the multiple collapsed so much that you didn't get a positive rate of return for the A shares. But that then suggests that since the A shares now have price earnings multiples that are basically at world standards or even less than in the United States, that that poor performance may not necessarily be repeated for the years ahead. Note also for the FTSE index, the price earnings multiples have actually risen. They're still not terribly high. You know, they're 13, 14, and similarly for the N shares. So basically, what has happened is that you've actually had some additional appreciation from price earnings multiple expansion for the H and the N shares, and that big contraction prevented you from making any money on the A shares. But now, valuations are quite reasonable. And in fact, I want to argue that price earnings multiples are indeed very attractive. There's a man who used to run a mutual fund called the Magellan Fund by the name of Peter Lynch. And Peter Lynch had developed a valuation theory which was what's called the PE to growth theory. And he said, how do you find attractive stocks? Well, you find attractive stocks that have high growth and low PEs. That was basically Peter Lynch's idea. And Peter Lynch coined the idea of looking at the PE to growth ratio. And what you want, ideally, you want a stock that's growing at 20% a year and selling at a PE ratio of 20. You want a low PE relative to growth. So what I've done here is the PE to G ratio for the US market is about 2. The PE to growth ratio for the A shares, the H shares, and the ADRs is below 1.5. So if you take Peter Lynch's idea that this is one way of looking at valuation, it looks like things are very attractive. Now, I've done a study that I think is a better one, which is what's shown here. And what I've basically done is a matched pair study. I've taken a Chinese company and then matched it with one or more equivalent companies selling in the United States. So if I take PetroChina, for example, I will match it with ExxonMobil and ConocoPhillips. I think that was exactly the comparison. So I'm taking a company in China, matching it with companies in the United States. And essentially what this shows is that the earnings growth on the darker bar, and incidentally, where I get the growth from is there is a service called IBES, which stands for IBES, Institutional Brokerage Estimate Service. It sort of collects the growth rate, the 5-year growth rate estimates from various analysts. And there's an international IBIS service. So the data mainly come from that service. And what it shows on these matched pairs is that the estimated growth for the Chinese companies are higher, the price earnings multiples are lower, and therefore the growth to PE ratio, which is about 2, which I already said it was about 2 for the US market, is about 2 for the comparable US companies, is considerably lower for the Chinese companies. So basically, one of the reasons that I'm optimistic about investing in China is I think the valuations are more attractive. And then second, as I've indicated, I believe you're likely to get long-run currency appreciation. It has always been the case that when you have had very rapid economic growth, that the currency of the country that was growing appreciated. This is the yen-dollar relationship. Japan had its growth spurt, and incidentally, one of the kind of interesting things is the growth spurt in Japan really started in the 60s after they had hosted the Olympics. And as Japan grew, the yen, which was 350 to the dollar, is now just over 100 to the dollar. The Japanese yen appreciated substantially. South Korea hosted the Olympics. I think it was 1984. 80? 88. 88. Thank you. South Korea then grew at a phenomenal rate. And the South Korean currency appreciated against the dollar. Now, again, I understand all of the political issues that are involved here, but at some point, the Chinese simply, if for no other reason than that they lose control of their monetary policy, you know, when you the central bank keeps buying up all of these dollars, and incidentally, they've got about $1 trillion of reserves now. I mean, it's about the same as what Japan has. They're going to find that, again, I'm not saying this is going to happen overnight, but there'll be a tendency, there'll be continued pressure for the Chinese yuan to appreciate in value. We've seen a 3% move last year. I think we'll see another moderate move. You know, our senators will complain it's not nearly enough, but you know, at least it's moving in the right direction. Now, you all know that I am an efficient market person. I mean, my book, A Random Walk Down Wall Street, basically is a book that espoused the efficient market hypothesis. And for a variety of reasons, some of which I've actually talked about here, that when you look at professional investment managers and you look at a dumb index fund that just holds the S&P 500 or the Russell 3000 or the Dow Wilshire 5000, that professional managers are beaten by the index. So you know, I've believed in indexing all my life. I believe in efficient markets. But I can tell you that the local A-share market is not an efficient market. And it's not an efficient market for a couple of reasons. One, if you look at the way prices develop in the United States, you'll find that it's very close to a random walk. And that's one of the sort of statistical tests that's often done. You know, there's almost no serial correlation. By serial correlation, what I mean is the price change today versus the price change yesterday. There's almost no serial correlation in the United States. When you do those tests in China, there's considerable serial correlation. The market is nowhere near a random walk. There's a lot of evidence of manipulation. And incidentally, that was one of the risks that I had mentioned about China. China has a Securities and Exchange Commission. One of the things I did was talk to the people there. It's getting tougher. It's getting better. Is it perfect? Is it like the SEC? No. But that's what I mean when I say at least the change is going in the right direction. But at any rate, the Chinese market doesn't look like a random walk. Also, managed funds in China beat their respective benchmarks, namely the Shanghai A-share index and the Shenzhen index. So the Chinese market does not seem to be efficient. One of the reasons it's not efficient is and this is another thing I've talked to government officials about, one of the ways you can make it efficient is whenever you restrict a market and don't let various people trade, international people can't trade in China. China has, in addition to mutual funds, there are things called closed-end funds that sell a lot of stock, and then they don't redeem or issue more, but the stock trades on the exchange. When I first wrote Random Walk in 1973, there weren't index funds, so what could I tell investors to do? I said, go buy closed-end funds that were selling at discounts of 30 to 40%. And it turned out eventually they went to par, and that was a very good investment advice. So the Chinese closed-end funds, which actually beat the indices, are selling at 40% discounts. So I tried to move heaven and earth to go and buy these. And there is something called a QFII quota, QFII, Qualified Foreign Investment Quota. There are tiny quotas that are available for doing actual portfolio investment. And they're being liberalized, just a little tiny bit at a time, not nearly as much as I would like, but I wasn't able to do it. So the point is, essentially, for all practical purposes, international investors can't buy in the Chinese market, and Chinese nationals, again, that's being liberalized a little bit, can't buy. And when you segment a market like that, that's how you can get it inefficient. So the Chinese market is definitely inefficient. Here's, I mean, it's just remarkably inefficient. Here's the returns year after year for managed funds and the returns of the Shanghai and the Shenzhen index. And this is what I mean when the US goes the other way. This is what I mean when I say the sort of term that finance people use is semi-strong form efficient. This is clearly managed funds year after year are able to beat the indices. When I was in China talking to local investors, I pointed out, hey, 45% discounts. This is what you would expect. I must say I was actually quite pleased that when I gave a seminar to a number of Chinese institutional investors, the discounts right after that went from 45 to 40%. So, eventually, this is the nice thing about efficient markets. It's like the old joke about the professor's walking along with his graduate student, and the graduate student sees a $100 bill on the ground and stoops to pick it up, and the professor says, don't bother to stoop to pick it up, because if it were really a $100 bill, it wouldn't be there. Now, my view is stoop to pick it up right away, because it's not going to be there forever. And this isn't going to be there forever. So this is closing a little bit now. But again, it's an evidence of an inefficient market. However, when you look at managed funds that can buy the ADRs or the Hong Kong stocks, and you compare that with this index fund, and this is an index fund, its ticker symbol is FXI. That's the FTSE Shenhua index. It's not the Hang Seng. The Hang Seng is an index of Hong Kong companies. This is an index of mainland companies that are traded in Hong Kong. And you can see that, in fact, that index does very well relative to managed funds. So that I would recommend, and I do think that indexing does have a role to play in the markets that are subject to international competition and therefore are far more efficient markets. So here's a place, indexing for local markets, no, but indexing for markets that are open to international competition, yes. Now, another argument for putting some Chinese stocks in your portfolio, I've already argued that, first of all, they're attractively priced, that you're also going to get some currency appreciation. But another argument is Harry Markowitz won the Nobel Prize in economics for pointing out that what was key in reducing the risk of a portfolio is to have something in your portfolio that is uncorrelated with what you've already got, and even better if it had a negative correlation. But what Markowitz showed was, as long as it isn't perfectly positively correlated, you can have a correlation coefficient of 0.5, and you can get a lot of benefits from diversification. Well, what this shows is, this may be very hard for you to see, but these are the Shanghai and the Shenzhen indices, and these are rolling 3-year correlations, and they're very close to zero. In other words, these markets tend to be uncorrelated with the U.S. market. And what you probably can't see is this light line here that has the negative correlation, and that's the Goldman Sachs Commodity Index. So keep that in mind then in terms of the diversification benefits of having some Chinese stocks. Now, because the Hong Kong market and Taiwan markets also are very definitely open to international competition, the correlations are higher, but still low enough that there are important diversification benefits for a U.S. investor who otherwise just has U.S. Equities and bonds. Now, again, plenty of risks. There are macroeconomic risks. Governance among Chinese companies is not what it should be. One of the things that I did over there, though, was to talk to the head of the Hong Kong Stock Exchange, and they have really made a lot of progress on the governance front, requiring quarterly reports, and you know, there's been an enormous. You know, I'm not saying it's riskless. There still is too much. One of the other things is there's too much government ownership, and government ownership has two problems. This is really the second bullet here. One problem of government ownership is that the government may have different objectives than a stockholder. In fact, this is what happened to the Chinese banks. The government says there's a failing manufacturing firm out here. We don't want them to go bankrupt because there will be unemployment then, and then there may be some political instability. So the government, if the government owns 75% of the shares, the government says to the bank, lend money to these people. That's one of the reasons why there's a banking crisis in China. Well, that's why they have a so-called non-performing loan problem. Now, there's a second problem. The government recognizes this, and they're cleaning up the banks and getting rid of the shares. But that has another problem, that if all of a sudden those government shares come on the market, that'll tend to depress the price. So, you know, you're kind of damned if you do or damned if you don't. But that's the overhang problem. There's also the problem of what is just extreme volatility. As you can see on this volatility index relative to the United States, the Chinese market is even more volatile than Brazil, which is known as the sort of poster child for a volatile market. So look, going directly into Chinese companies has got a lot of risks associated with it. No question about it. And therefore, I believe that the wisest course and the one that has the best risk-reward ratio is a mixed strategy that does some direct investment in Chinese companies and also some indirect ways of benefiting from the growth of China. And so what I want to turn to now is, what's this good mixed strategy likely to be? Well, again, to the extent that you could get into the local market, I think, and I'm an indexer, I think you need to go with managed funds. That market is not efficient. Maybe it'll become efficient at some point, but it's nowhere near efficient. It's also the case that one of the reasons that you want to index is you don't have any transactions costs. You're not buying and selling all the time. In fact, people complain about the Standard & Poor's 500 stock index. They say there's too much movement. It's a managed index. There's a committee run by David Blitzer, and they decide that Google's going to get in, and somebody else is going to go out. So there's a little turnover in that index. The turnover is 3% a year. What we're talking about in the Chinese indexes, since they're all so-called float adjusted, the weights depend upon the float that's outstanding. As the government sells off its shares, and the government has just announced plans to sell off more and more of the shares, the index is totally unstable. I mean, even if the market, you know, there was no corruption, even if the market were totally efficient, it moves around too much. There's too much transactions cost for it to be an effective strategy. In the Hong Kong H-share market, however, the indices are more stable, and I've already suggested that managed funds don't beat that index, and passive management does have a role. But let me now turn to, are there indirect ways of benefiting from the growth of China? And I'm going to suggest to you that there are, in fact, a number of indirect ways of benefiting from the growth of China. And one indirect way is to invest in China through Japan. Now, Japan has come out of its over a decade slump and is now growing quite smartly, and I believe largely because of China. That Japan has benefited in two ways. Number one, Japan's a very high-wage place, and so what many Japanese companies now do is do their manufacturing in China. They also have benefited by selling a lot of heavy equipment. I mean, the kind of construction that's going on in China. You know, you're in one part of Shanghai, the Pudong area, which looks like about 6 New Yorks put together. And people tell you, you know, 10 years ago, this was a rice paddy. I mean, it's, Japan benefits from a tremendous amount of exports into China. And it's also helped the Japanese economy. So one of the ways of benefiting is to invest in China through Japan. Goldman Sachs does, I think, a very interesting index, which they call It's an index of Japanese stocks that they call the China basket. And you get into the China basket for one of two reasons. One, you do a lot of exporting to China. It's a big part of your business. Or you do your manufacturing there. So you benefit one way or another. And these are companies, Goldman Sachs publishes the companies. The companies aren't secret. Here's to the present what's happened. The TOPIX is the Tokyo Stock Exchange Index. The China basket has done many times better than the stock market in general. So one way of benefiting from China would be to buy some of the Japanese companies that, in fact, benefit from their relationship with China. Now, the same thing is also true of Taiwanese companies. The same thing is true for the companies in Hong Kong that are Hong Kong companies. In other words, I'm not talking, remember, the FTSE Shanghai index is mainland companies. I'm talking about companies in Hong Kong that actually do their manufacturing in the mainland. So this indirect method would be to benefit by going to places that themselves are benefiting from the growth of China. A second possibility is investing in natural resources. One of the lines I always like to use is, if China makes something, its price is unlikely to rise. I mean, one of the reasons why there's been so little pricing power on certain manufactured goods is because of international globalization and international competition. But if China needs to buy something, its price is likely to rise. I mean, you know, there's a lot of speculation in the oil market, and I'm not saying that $70 oil is entirely justified by supply and demand, but there clearly has been, from China and India, the growth in the demand for oil has been just enormous. Here's just another example: timber imports. Look at Chinese timber imports. And you can do this for not only oil, but you can do this for almost all the materials. So then another way of benefiting from the growth of China is by buying funds that basically benefit from prices of natural resources going up. A third indirect way is to invest in China through U.S. companies. Example, I don't know whether you visit Walmart. You may never have stepped foot in a Walmart, but if you do, more than half the stuff that Walmart sells is made in China. And more importantly, Walmart is expanding rapidly in China. So that it's obviously a very indirect way, but there are companies in the U.S. such as Walmart that benefit enormously from the growth of China. Okay, here's another one. You walk down the streets in Beijing, and it's like on almost every corner you see a Kentucky Fried Chicken. And next to many of the Kentucky Fried Chickens are Pizza Huts. Well, that's owned, those are the brands of Yum Brands, is the name of the company that runs this. And again, the expansion of Yum Brands and an increasing share of their earnings is coming from the growth of China. Prologis is an REIT. It's a real estate investment trust. And much of their growth is now coming from development of properties in China. So a third indirect way of benefiting from the growth of China is by looking at some U.S. companies that particularly benefit from the growth of China. So, in conclusion, while there are certainly risks, I think the chances are very strong that China will be the fastest growing economy in the world over the next decade. Certainly has been over the preceding decade. Chinese stocks, including those open to U.S. investors, are very moderately priced, relative not only to the U.S., but to other international equities. Certainly, but European equities, this seems to be quite moderately priced. Understand the risks and therefore recommend a mixed strategy involving both direct and indirect investment products provides, I believe, the best risk-reward ratio to benefit from the growth of China. Now, I am sponsored at this by a company in Oakland that I've been working with, Active Investment Advisors. One of the things that they do is do index funds that can actually provide for doing better than the index by harvesting tax losses. We've also, I chair their investment committee, we have developed a product that does exactly what I've suggested. It takes a lot of exchange-traded funds, low-cost exchange-traded funds that meet this objective of some direct, some indirect ways of benefiting from the growth of China. It can be tax managed for the investor, and there are a number of people from Active around, and if any of you, cared to see what this was, we can certainly provide the information for you. So those are, I think I talked about an hour for prepared remarks, and I would be delighted to try to respond to any questions that you might have. Yes, sir.
So much of the talk was sort of investing in the public markets, but what's your thoughts on sort of the earlier stage investment? So a lot of venture capital going into China, perhaps private equity deals.
Could you repeat the question, Bud?
Sure. The question was, I basically, in my talk, talked about portfolio investment, talked about buying the securities for an individual, buying the securities. What about actual private investments, either from individuals making venture capital investments or for companies making foreign direct investments in China? And I believe that the latter may be an even better way of accessing the Chinese market. My own university has a very big stake in China, and it is done entirely privately. And in fact, one of the things that I did when I was there is talk to the people who manage Princeton University's portfolio of private investments in China. The private investing has a particularly good advantage that typically with a private investment, you not only put the money in, but you also help with the management expertise, and you actually have some people right there on the ground. One of the things I mentioned as one of the risks is if you go in and buy a company that's 75% government owned, you've got a real, it's what we call agency problems. You've got a real potential issue as to how this is being run. To the extent that you put private money in, you even put in people on the board, and you do this locally with people who've got their own skin in the game, you've got a much less risk way of doing it. So yes, I talked only about portfolio investment, but all of the Princeton University investment is being done privately. And in fact, you can get even better deals. The multiples of cash flows at which you're able to put money in with entrepreneurial people in China is even better. So that my own view is that that's an even better way to access the market than through the public market. Now, that doesn't mean the public market's not a good way to do it.